Hey guys, welcome to the WMS 2026 federal budget update. I haven't done one of these in the last 5 or 6 years because there's been nothing to talk about. We normally look at it and go, not worth it. I can't say that about last night. That is the most consequential budget that I've seen in 25 plus years. And the impact on our clients is going to be immense over the next few years. So I thought I'd take a few moments to explain to you what was in it, what are the concerns. I do believe we'll probably have to do another video when we know more in the next few weeks or months. Excuse me if I say something wrong, I've misinterpreted something. I'm just working off the material from last night. I'm going to start with the most impactful changes. And the most impactful change is the minimum tax on trust distributions that's coming in from 1 July 2028. That is as big a change as I've seen on trusts ever. And essentially what that means is every trust distribution will just have a minimum tax paid of 30%, regardless of the taxable income of the beneficiary. As you know, we use trusts to spread income around a family group, including a company, to keep the tax rate nice and level. Unfortunately, from 1 July 2028, trust distributions will be taxed at 30%, regardless of the income level of the beneficiary. What's even worse, and the government don't even hide this statement, is that if you want to distribute to a corporate beneficiary or a bucket company, you do not get a credit for the 30%. Individuals will get a credit for the 30%, apply that against their tax payable. It's a non-refundable credit to individuals, so it's always going to be 30% regardless. Companies do not claim that credit. They're not eligible. So in essence, the distribution to a company will be subject to tax twice. And that is the first time I've ever uttered those words. So we are looking at an effective tax rate of maybe 55%. So this means, in my view, if everything goes ahead as planned, the death of corporate beneficiaries. And the government have made it very clear they want everyone to transition and restructure into companies from trusts. This is a massive attack on the use of trusts, which is the most common vehicle we have in tax. This is going to result in so many changes to structures. I've already had emails and texts and calls already this morning about what does it mean for things that are happening right now. And we're just going to have to look at everything in isolation and see where we land. But I can tell you, in 2028, we're about to have a whole new system of taxing trusts, and it's going to be a massive change. Now, it's hard to believe that the removal of this capital gains tax discount would not be the most impactful change, but I think it's actually the second biggest change, and that's why I'm mentioning it now, is from 1 July 2027, the 50% discount on gains made on assets held by individuals and trusts for assets held over a year will be removed. And that has been in place since 1999. So again, this is a massive change to the way capital gains tax works. And so basically what the proposed arrangements are is assets bought before budget night will be grandfathered in and allowed the discount, the 50% discount, to apply on the value of the asset increased up to 1 July 27. So in essence, it looks like we'll have to get everything valued, and the value increase from when you bought the asset to 1 July 2027 will be eligible for the 50% discount. And after that, any increase in value from 1 July 27 will be determined based on an inflation-adjusted capital gain. And so basically we're going to have assets, the longer you hold them after 2027, will be subject to less and less of the capital gain discount, more will be taxed on the inflation-adjusted cost base. In addition to these changes, they've introduced a minimum 30%. You see that number's coming back again, tax rate on all capital gains. So whatever your capital gain is worked out under the method we talked about earlier, the CGT discount or the inflation-adjusted model, will be taxed at 30%. So they're driving us back to a common tax rate of 30%. And so in essence, if you sell an asset before 1 July 27, that's eligible for the discount per normal, that's fine, you can claim the discount, but any sales after 1 July 27, we've probably got a hybrid calculation to do. Now this impacts everything we do. When we advise clients about buying assets, we've always favoured trusts, as is every accountant in Australia, because of the CGT discount. That discussion as of today is going to be very different. And I see a world where we're buying a lot more assets in companies rather than trusts, which is exactly what the government want to do. So they're trying to get us to move assets into companies where they can control the tax rate and there's no shenanigans in their world. But the removal of the CGT discount, which is not a surprise, we knew that was coming. At least they've grandfathered assets that were held at budget night. But in essence, if you buy new assets after today, and you sell them after 1 July 2027, you will not be eligible for the CGT discount. You'll have to use the inflation adjusted model, which is what we had up until 1999, but with inflation running at 3%, I do believe you'll be worse off over time, but it will change the way you buy assets. So you'll need to engage with us and talk to the team on how to structure assets moving forward and whether you want to move assets that you've already got in your group to take advantage of whatever these changes might result in. Another change sort of included in both the trust minimum tax and the capital gains tax changes is also a very sneaky little change about pre-1985 assets, which I know that they're not that common these days, but it would appear that pre-85 assets owned by trusts, which I said is not that common, will be brought into the capital gains tax system based on their market value at 1 July 2027. So the ability of a trust or an individual to own an asset that's pre-85, and a lot of farms and a lot of assets that have been held in the Gold Coast for a lot of years are pre-85 assets. They will be brought into the capital gains tax net at market value at 1 July 2027. So that's a fairly major change that just didn't get a lot of press last night, I suppose due to the fact that the assets that were acquired pre-85 are not that common these days. Again, I've said it before, I couldn't believe how many changes there've been in the budget to actually get to the third most impactful change, the removal of negative gearing. If you had have told me a year ago they were going to remove negative gearing, I would have thought that would be the worst change we'd see. That is not even the first one I'm worried about. It's number 3. So in essence, from 1 July 27, for all entities other than super funds, I believe, and managed investment trusts, you can't negatively gear residential property. So it's fine to negative gear shares and commercial property, but residential property, if you negative gear it, and by that I mean you make a loss on the rent and the expenses exceed the rent, you cannot claim the loss for properties acquired after last night. So unless you had a contract in place, you're okay last night, that settles after today. But if you buy a property today, if I run out there and buy a property today and I negative gear it, I cannot claim that loss against my other income. I have to hold that loss and carry it forward until that property makes some money, or I sell the property and make a capital gain. So in essence, they're quarantining newly acquired properties after tonight from negative gearing benefits, and you'll have to defer the loss. The only exclusion is properties that are what's called new builds. So that is essentially properties that are adding to the supply of housing in Australia. They're excluded from this negative gearing change. So if I go out today and buy a brand new property that's off a developer or something, I buy a brand new, I'm able to negatively gear it. But if I buy an existing property, I cannot. The good news is they've grandfathered existing properties. So if I've bought a property last year, I can continue to negatively gear it as long as ownership doesn't change. So we need to be really careful of not accidentally triggering something where the negative gearing new rules might apply. This would appear to be a major change, but I think the fact they've grandfathered it for existing means it's prospective, and they've also excluded new builds, and there's quite a bit of conversation and discussion on what is a new build, and there's some examples in the budget papers, but they're trying to encourage negative gearing of new properties, not existing. So young home buyers apparently can go buy existing, and they're not going to be flooded with the negative gearing investors coming into the market after last night. A glimmer of positive light on all these changes is the permanent extension of the instant asset write-off from 1 July 26 of $20,000. So if you're a small business entity with a turnover of less than $10 million, you can buy an asset that costs less than $20,000 and immediately write that asset off against your taxable income. This should be the case. I'm glad they've brought this in. It seems not a great deal of compensation for everything else they've done to us, but it's something you acknowledge that it's good that we can claim instant asset write-off on smaller cost assets. I mentioned this one for comic relief. The government have introduced a working Australian tax offset, which is the grand total of 68 cents a day or $250 a year. from 1 July 27. I think I spent that on in my fuel this morning on the way to work. So, and that's available for people who are earning salary and wages, or sole proprietors or sole traders earning business income. And again, in the scheme of things, with the cost of living, it ain't going to make much of a difference. Another positive change is the reintroduction of the loss carryback rules that were reintroduced for the first time during COVID and now being brought back in again. And I think it appears that they're going to be permanent. And that allows a company to carry a loss back. So it can have a loss in, say, 27 and can apply a loss against the profit it made in 26, because obviously losses are normally only carried forward. They can be carried back up to 2 years now under these new rules that have been reintroduced. So in essence, it allows for cyclical trading and the unfairness that sometimes happen when you pay tax on some money you make in 1 year, you lose that money the following year and you're not getting a credit for the fact you've now lost that money. Now you can go back and apply that loss against the previous taxable income and get a refund of the tax paid. So it's a welcome change, but it's a logical sort of change that probably should be in as part of our tax system generally. There's a new measure about startups that are small businesses that incur some losses in the first couple of years of trading. The government's proposed from 1 July 28 to give those loss-making companies a refund, basically a refundable offset, limited only to the expenses on Australian wages and the provision of Australian fringe benefits. So in essence, it's the government trading off a loss you could carry forward with a refund. So it's like a wage subsidy, but it's 1 July 28. Details are very sketchy. We'll know more in the next couple of years. The government has also enhanced the R&D, or research and development tax offset, increasing the offset calculation from 25 to 50% and lifting quite a few thresholds. It's to encourage innovation and speculation in research and development. It does, with all these capital gains tax changes that we have, we are now a very high tax country on capital. And if you listen to the commentators over the last 12 hours, they're all talking about this will see a flow of capital out of Australia as entrepreneurs go to places like Singapore where there's no capital gains tax. These changes for R&D and the startup change I mentioned earlier are meant to keep them here. Whether they're enough, who knows? But I know as a result of this budget, startups will pay more tax over time. That pretty much covers most of the major changes. There's other stuff there about electronic vehicles and the FBT exemption, which we can cover at a later date, or you can take a look at the budget papers yourself. They don't come until 2028 or 2029. There's already some ideas and strategies that are coming to mind even since last night about how we can structure you moving forward to basically minimise the pain from these changes. So if you've got any concerns or you're alarmed by them, please reach out to whoever it is at WMS you deal with, and we'll give you some ideas and we'll work with you over the next year or two to work out whether we need to move things around or undertake any restructuring. The government has said they'll be introducing a new restructuring rollover that allows us to move into companies. Again, we haven't seen what that looks like. So again, reach out to us if you've got any queries, and we'll just work with you over the next few years to come up with a plan. Look, I cannot stress the impact this budget's going to have on the way businesses are structured and operate in Australia. I see the next 3 years we'll be restructuring a lot of assets and a lot of businesses into companies. Every structure I can think of will change for clients. The work begins as soon as we know that this is the rule, these are the rules we have to deal with. The uncertainty of the political system means sometimes we may not know exactly where we're going to land for a year or two. So we just encourage you to engage with us. We're concerned. We're thinking about clients and things that we can do to help out. Reach out to your team at WMS or myself if you've got any queries, and we'll do our best to speculate and work out how do we best avoid the real big tax costs of this budget. But I've got to be honest with you, I feel we're all going to pay more tax, or certainly it's going to be more challenging. So you need to work with us over the next couple of years to plan for these changes. So thanks for your attention.